U.S. economy surges. Despite Moody's Fed doubts, Trump policies at play, the latest U.S. economic data is surprising markets and analysts alike, as growth continues to accelerate, contradicting earlier warnings from credit rating agency Moody's and cautious forecasts from the Federal Reserve. From job creation and consumer demand to GDP growth, the American economy is outperforming expectations across the board. In late 2023 and early 2024, Moody's issued a negative outlook on the U.S. credit rating, citing rising national debt and political dysfunction over fiscal policy. Simultaneously, the Federal Reserve warned that high interest rates, implemented to tame inflation, would likely slow economic activity. Fed Chair Jerome Powell repeatedly emphasized that a softening of the labor market was necessary to stabilize prices, but the first half of 2025 tells a different story. In the latest labor report, the U.S. economy added more than 270,000 new non-farm jobs, shattering forecasts of just 180,000. Unemployment held steady at 4.0%, a historically low level, while average hourly earnings rose 4.1% year over year, outpacing inflation, which has cooled to approximately 3.3%. GDP numbers are equally impressive. A revised estimate for Q1 2025 showed 2.3% annualized growth, higher than the Fed's own forecast of 1.8%. Consumer confidence is rising, and corporate earnings are improving across a wide range of industries, from technology and services to manufacturing, signaling broad-based momentum.
Critics say Moody's placed too much emphasis on political theater around the debt ceiling and underestimated the market's continued faith in U.S. institutions. Treasury yields remain stable, and global demand for U.S. government bonds is strong, showing little sign of credit risk. Meanwhile, the Fed's ongoing hawkish stance is increasingly being called into question. While the aggressive rate hikes of 2022-2023 were arguably justified, maintaining high rates well into 2025 may now be restraining investment and housing recovery. Despite inflation showing clear signs of control, many economists argue that the current strength of the U.S. economy is not merely accidental, but a delayed and lasting result of growth-focused policies implemented under former President Donald Trump. These included corporate tax cuts, deregulation, pro-business trade renegotiations, and infrastructure initiatives, all of which laid a foundation for a more resilient private sector that continues to drive recovery in the post-pandemic era. In short, as Moody's and the Fed now scramble to revise their outdated projections, it's becoming increasingly clear that Trump-era economic policies, once controversial, are proving their long-term effectiveness in ways even skeptics can no longer ignore.